now in a situation when a SME approaches you and you want to add that influx of capital to that company, I want either one of you to break down what are the starting points of this journey and what the journey looks like. Like when a hypothetical company has approached you and say that, hey Kunal, I need to raise funds, I might even want to go public. What does the journey start with and look like?
Initially, the first thing is to understand and analyze the company, right? I mean, which again has to be a fairly detailed one. It starts from understanding the business, the various drivers of business, where they are standing. Why do they think that they have growth parameters ahead? How their entire environment is shaping up? Who would be their peers? And then you try to understand what is the competitiveness of the business which they have built, which is again reflected in the margins of the business. Who would be their suppliers? Who would be their key clients? How their clients are looking at this entity? You need to do a little bit of a forensics here. You need to do a little bit of scuttlebutt here, in the sense that you have to understand from the market, how the market thinks about the
market sentiment.
Right? There, I mean, people around them, what's their view on the company? Who are their bankers? It's extremely important, who are the bankers? How much is because that itself gives you a lot of comfort and discomfort, right? A good bank in the company means that, those banks have done their homework, right, before lending them.
So in a scenario, if the company is a startup and doesn't have any prominent bankers or investors backing it, in that situation?
See, that is a very different form of fundraising which we are talking of, right? When you're talking of equity fundraising for startups, it's an entirely different model. You're talking of VC kind of an investing. You're talking of an investing where you're looking at either your money becoming multiple times in a short span of time, or there's a risk of the startup not scaling up and your money not kind of giving you the return, or not even coming back in its entirety to you, right? We are talking of a space where a more mature space where we are talking of enterprises which have built a certain scale. Let's say 200 crores of top line, right? Or let's say 250 crores of top line. But then they see a long runway, and then the promoter, let's say, believes that in the next 3, 4, 5, 6 years the company can grow 15-20% organically on its own in the setup it has created for itself. But if it is given external capital, equity capital, the growth rates can move from 15-20% to, let's say, north of 25-30%. That's CAGR. That's very high. 24% CAGR would double their base in 3 years, right? 35% CAGR, 36% CAGR doubles their base in 2 years. So when a promoter is very confident that on its own it can grow at a certain rate, 15, 20, 17, 18, 20%, but with the help of additional capital, the growth rates can be much faster. See, they can go for large capex, they can go for new product development, they can go inorganic, they can acquire some of the smaller peers. There can be multiple triggers for a faster growth. And if your homework tells, if your scuttlebutt, if your own forensics tells that yes, the company is in the right space, the company is positioned well, and it can move on it can change its orbit, how we call it, right? Then you back them. So then you start, you create the entire participant network to take the company public. In the meanwhile, many a times promoters see immediate deployment of capital. They see opportunities. Let's say they have to start a capex. The going public takes a bit of a time, so you can raise some amount of capital for them quickly in the what we call it pre-IPO, right? A small portion, small part of the overall IPO as a pre-IPO capital for them to fast track their growth, right? They can immediately order the machineries or give orders to contractors for building the the entire sheds and all. Or if they are targeting an inorganic growth, they can start a dialogue with some of the potential sellers immediately, or they can slightly deleverage themselves if at all there is leverage ahead. First of all, I don't think that leverage companies can create any sustainable value in the market unless there is a clear growth path, unless there is a clear path to deleveraging, right? Equity capital is not a cheap capital, right? I mean, equity is an expensive form of capital. So end of the day, it has to be used to generate higher returns, right? equity capital can not only be used, should not only be used to deleverage, right? I mean, partly yes, in case you have to. In case, we have to see what is the debt equity, debt EBITDA, different parameters we see to assess the leverage in the entity. But in case that, the leverage is not too high, ideally, the equity capital raised should be utilized to generate higher returns on capital. So ROCE, if the money can be used to generate a 20-25% ROCE, right, or north of 20% ROE from the redeployment, that's better rather than just repaying it and reduce your interest cost, which can probably save you 10% or 9% or thereabouts. That should only be done when your leverage is very high, which is actually not creating equity value for you. End of the day, enterprise value minus debt is equity value, right? So if your debt is too much, you yourself are hurting your equity value and the investor's interest also, right? One thing is for sure, if any entity continues to remain deleveraged for a long period of time, you can do any kind of homework and see that those entities don't create sustainable equity value also over that period of time. So leverage has to be absolutely controlled. This is what I believe, and leverage has to be seen in the context of what is the net worth of that entity, which is what I said, that equity. It has to be seen in the context of the value add which the business generates, which is measured in terms of EBITDA percentage, right? So again, leverage has to be seen in terms of how much is the total debt in the company vis-a-vis the EBITDA which the company is generating.
Kunal, do you have anything to add more?
So, of course, I mean, Hemant sir touched up on all the important points in terms of, what do you look at technically, what do you look at, how do you look at sectors when you analyze a company, or what the industry growth is expected to be. What I would like to add is that the first thing that we look at as a family office who would invest in private companies is the quality of a promoter. So, what that means is that if you have a great company but an average promoter, it is less likely to succeed than having a great promoter and an average company.
Okay.
So every business has upturns and downturns, up cycles, down cycles. It's not every day is the same in running any kind of enterprise. But the intent of the promoter is what matters the most. Whether they have the mettle to face, any sort of adversity that comes in the business, any sort of sector downturns that come in, in that particular sector or that business. And if they do, that means they can withstand any kind of, any kind of difficulty that could arise in a business. So I think the quality of a promoter is just as important, if not more important, than the actual fundamentals of the business.
Fair point. And I feel like any company or any entrepreneur listening to these points of the analysis bit, it's very important for them to consider all these different points that both of you listed out, because every company who wants to be listed has that aspiration that, okay, one day I want to be on the stock list exchange, but they have to complete this homework first before even approaching or even dreaming about that dream. But once this analysis is complete, what is the next step in the IPO journey of a company?
So you formalize the arrangement with the company that they have to go public. You explain them everything, the timelines, the process, the cost structures, and then you go on to create the entire ecosystem.
What is an approximate timeline, sir, for this?
Okay, so depending on whether the IPO will be main board or SME, the timelines differ. For main board IPO, timelines are slightly bigger. They could be, let's say, a year plus. But for SME, assuming the clients information flow is very good, and they are able to provide all the required data, info, documents, everything on time, it could be as less as 6 to 8 months or so, 6 to 9 months, let's say.
SMEs, it is become relatively very easy now to list, also because how well the platforms have been built by both the exchanges, the National Stock Exchange and the Bombay Stock Exchange, and they have a large role to play in this in terms of providing this kind of equity capital to all of these SMEs. So timeline for SMEs, like sir said, up to 6 months. If from today you start, working with a company, you can aim to list the company within 6 to 8 months time. In fact, there have been occurrences where companies have gotten listed in 3 months time, but that again all depends, like sir said, on how forthcoming the promoters of the company are, how quickly data is being received by the bankers or whoever. So what happens is that an important point to mention here is that before listing or when you go for listing, there's a document which is prepared, which is submitted to the exchanges for approval, which is called a DRHP, which is a draft red herring prospectus. This prospectus is basically everything about the company from day one of its inception. Everything, like there's not one part that is missed, all kinds of disclosures, whatever the company has gone through in its history comes into the DRHP, and this DRHP is produced on the basis of the data which is provided by the company. And of course there are independent stakeholders who play a part in preparing that as well, but if a company is very forthcoming with its information and if they're able to provide it quickly, you could look at a listing in 6 months time.
Okay.
And how crucial is the investment banking's role, sir, in this whole process? Because you are coming from an investment banking perspective.
Yes. See, investment bankers are basically the advisors, people who handhold the entity and its promoter, right? I mean, a lot of times people are misguided. A lot of time wrong advices are given to promoters. A lot of time, see, capital markets, as I say, there are all kind of participants in capital markets. There are the good, clean guys also. There are people who have their own vested interests and they don't give the right or the best of the advice to the promoter. So a good investment banker will always speak what is right. Sometimes it may not sound sweet. Sometimes, it may, in the short term, the promoter may get an impression that it's not in the best interest of the company. But the right advice will always take the company over a longer and a cleaner, sustainable growth trajectory, right? For example, a lot of times there are people who give certain kind of wrong valuation expectations to the promoter, right? Which I believe is not correct, right? I mean, whether one gets a business or not, one should always tell what is doable, what is certain, what is possible, right? Rather than building any wrong hopes and then not delivering on them, which definitely strains the relationship amongst the participants, and it doesn't serve any good to anyone. This is what I've seen. So I think it's very important to be clean and transparent from day one, because a promoter eventually will figure out, right? I mean, when he's starting the journey with you, from day one, if you are clean, transparent, when you have explained him all the pros, cons, all the advantages, disadvantages, it would go a long way in building the trust and the relationship with him, right? Because he would know that you have explained him everything and what you told them at the beginning is kind of panning out, right? So in that case, he doesn't kind of doubt you, or he doesn't think that whether you are trying to please him or not. That goes a very, very long way.
Yeah, it builds a goodwill in the long run.
100%, it has to, and that is how businesses should be, right? That is how you are taking a company which is private to public. You are trying to advise them, right? I mean, obviously with the help of the entire ecosystem, the entire merchant bankers and the lawyers and the IRPR firms. The point is, if you don't give them the right advice, who would? The promoter has always run the company in a very, closed door setup, right? I mean, he would not be knowing anything about, how the capital markets work, how would the compliances work, how would the governance structures work. He knows his business. He knows his business very well, which he has built, but he doesn't know anything apart from that. As the right advisor, as the right guide, it's your role to see that the promoters are made aware of all the advantages and maybe any possible disadvantage, all the pros and the cons in going about the process, the right time frame it would take, the right cost structures it would take, and the right expectations regarding valuation. They cannot be expecting more than what is fair, and they should not be fleeced on the other side also, right? I mean, so it has to be a fair win-win game for the entire ecosystem. So investors have to get a fair deal, promoters have to get a fair valuation, and the entire participants who are trying to do that for the company. You know, let's the merchant bankers and the lawyers and the the IR agencies and the advisors, they all have to be, you know, rightly compensated. So there is a very thin line between what is fair and what is beyond fair. We should always be a few steps before what is fair.
So just to add into what Sir is saying, at the end of the day, what is the reason for taking any company public, right? This is like it's the most basic question that comes to mind. It's about creating value, whether that's value for the company itself, whether that's value for the investors, whether that's value for other retail participants in the market who invest in these companies. And when is this value created or unlocked? It's when the advisors or sort of the investment banks that assist you in this entire process have the right intent in terms of valuations, for example, in terms of everything else, not just valuations, but your regulatory compliances, assisting the company in a strategic sort of way over the next couple of years, helping you plan your growth, giving you the right advice, even if it sounds wrong in the near term. So to unlock all of this value, investment banks play a really important role in how they guide you. It could absolutely create a lot of value, or it could destroy the existing value itself. So investment banks, have a large role to play in sort of how well a public issue is managed, or how a company does after listing also, for that matter.
Yeah, and I feel the right guidance and the right ethics is even more crucial at like this inflection point of India, where we are seeing such a boom in the SME market, and every other company might be motivated to see how their company performs on the stock exchange, and them coming to you with all the excitement. At this point, it might be very tempting for a lot of investment banks to like just take the business, for the lack of better words, but telling them that probably this is not the right time for you to go public is what matters the most.